Welcome back. Today we are going to learn about risk and return. Till now, you have learned about the basics of the financial management, that is, three decisions which we are going to take in financial management. Then we learned about what should be the objective of decision making, that is wealth maximization for the shareholders. Nevertheless, we must take into account the corporate governance principles and the corporate social responsibility into account while making all the decisions. Then we learned about the first fundamental principle in financial management is time value of money. We learned about the different cash flows and how to calculate the present value and the future value of those cash flows. Now we are going to learn another concept, which is return and the risk. So let's learn about this. So let's learn some very basic concepts of the return, that how we are going to measure the return. Return, as I say, is always what is the price at the end and what is the price at the beginning divided by price at the beginning. So when I say price at the beginning, I say return is equal to, let me take some good pen, and this one, return is equal to price at the end minus price at beginning, and we will divide it by price at beginning into 100. Done. So, and if I have selling price and the purchase price, I can take selling price minus purchase price divided the purchase price into 100. So that is my return percentage. Now from the income statement, let's understand, every time we are going to talk about the return in the company, we will talk the concept related to the cash flow and we will not talk about the pure earnings. Okay, let's understand when a business how the business generate the cash. Business generate cash from utilizing its assets, and business is going to pay that cash to the liabilities. So from business point of view, we will calculate the cash flow for each component, whether it is cash flow to the business, cash flow to the debt holders, cash flow to the equity holders, and cash flow to the each asset, while calculating the valuation for the valuation purpose of that particular asset or liability. Now let's learn more concepts related to the return. It could be a single period return. It could be a multi-period return. Similar to this is, it could be an annual return. When I say single period return, it could be an annual return. And when I say multi-period return, it could be an holding period return. Holding period return means you are not going to hold the asset for, you are going to hold the asset for more than one period. Now let's learn. So if I am having such kind of returns, these returns are not comparable. When these returns are not comparable, we preferably want to have the annual return, or rather, if it is not annual, so what we will do, we will annualize the return. Okay. Now, when we are coming to the, when we are calculating the average return for each year, and when we want to calculate the average of these, which average we should use? Should we use arithmetic average or should we use geometric average? Let's learn that what is going to be the effect of this. When I take the geometric average, it talks about compounding effect. Okay, and when I take an arithmetic effect average, it doesn't go for compounding. So when it doesn't go for compounding, so obviously my geometric average will always be, my geometric average will always be less than my arithmetic average. Let's see. If it is 2011 to 2015, this is the holding period. Okay. these are 5 years, so I divided it by 5. So if we will calculate the arithmetic average, it comes out to be 16.7%. But if I take the geometric average, how do I calculate the geometric average? Natural log last price divided by the first price. Okay, so how do I calculate the geometric average for this? So geometric mean for this will be 5000 divided by 3000, and here the number of n is 1 upon n, or I'll take 1 upon 5 over here. Okay, so here it is ln, and I need to put here 1 upon 5. Done. So this is my geometric average because it is going to take the effect of the compounding. Here also 2011 to 12, but if I take geometric average and the arithmetic average, the effect will be different. Let's see, talk about here also. Same thing. Even if there is no gap in between the years, the geometric average and the arithmetic average are going to give me the different answer. Now, what do I use in the company? So when we are talking from the business perspective, from the accounting perspective, we will prefer arithmetic average. But when we are talking about from the perspective of stock market, since the compounding is continuous over there, so we will prefer the geometric average over there. Another advantage of the geometric average is that I don't need intermediate years. Okay, since it talks about the compounding effect, so it gives me the better answer as compared to the arithmetic average. Now, having said this, this is for the single asset, but in my portfolio there could be multiple asset 1, asset 2, asset 3. Let's say the weight of this asset is W1, weight of this asset is W2, weight of this asset is W3. How do I calculate the weight? The proportion of the amount which I have invested in asset 1, suppose I have invested 100 rupees in this, 200 rupees in this, and 300 rupees in this. So total amount comes out to be 600, right? The sum of this comes out to be 600. So weight 1 will be equal to proportion which I have invested in asset 1 divided by the total. So it comes out to be 100 divided by 600. Suppose the return of this is 10%. Return of this is say 15%. And the weight is 200 divided by 600. Return of this is 20% and the weight is 300 divided by 600. Okay, so my portfolio return will be WI into RI divided by sum of WI. So if I will calculate the sum of these WI, it will always come out to be 1. So I'll say 10% into this, 15% into this, 20% into this. It comes out to be 1 upon 2.5. It comes upon to be 1.3.33. It comes out to be 1 upon 6. Okay, so if you will add everything, it will surely come out to be 1. Okay, so this is about return. Now let's come about risk. What do I mean by risk? Risk is a measure of dispersion. Okay, so when I say dispersion, what do I mean in the financial management? This means because we are not going to get the same return every day, but we are going to talk about the average return. So I wish to know whether my average return is an actual average, whether it is a true representation, or do we face any kind of risk. Risk means that I'm not going to get the same average every time. It is going to be the different return every time. So that is my risk. I'm not going to get my expected return. Clear? So when we are going to calculate the risk, there are two methods. One is I calculate the absolute risk. And when I say absolute risk, that means it is the particular risk relates specific to that asset only. And the measure which we use frequently in the common literature in finance is standard deviation, though we have number of other measures also, but for my basic level we are going to consider standard deviation only. So what do I mean by standard deviation? If it is in population, so it will be x minus x bar whole square divided by n under root, and if it is a sample, it will be x minus x bar whole square divided by n minus 1. So I can simply calculate the standard deviation of a series of the returns, and I can know what is going to be the risk for that particular. Now, when we are calculating return and risk, our assumption is all the returns are normally distributed. So this assumption is very, very important for me, because when I am assuming normal distribution curve, my standard deviation gives me a probability. Okay, probability that my returns will lie in this particular area. So this is an average. Average plus minus 1 standard deviation covers 62.26 of the area. Average plus minus 2 standard deviation covers about 95% of the area. Average plus minus 3 standard deviation covers 99% of the area. What does this mean? If my return is 15% and my standard deviation is 3%, okay, I say standard average plus minus 3 standard deviation, or plus 3%, 1 standard deviation. The probability that my returns will be between 18% to 12% is 0.68. Okay, this is the probability that I can have my return from 18% to 12%. Okay, 15%, 2 into 3%, that is 2 standard deviations. So 6 plus 15, 21, 21 to 9%. What is the probability that my return will lie in the range of 21% to 9% is 0.95. Okay, that is the probability. Now 15% plus minus 3 standard deviation, that is 9%. So what is the probability that my returns will lie between 24% to 6% is 0.99. So it gives me the probability where my returns will lie. So that is the advantage of using the standard deviation as a risk and assuming that all the returns are normally distribution. But over the years we have seen, and that is a common fact that we have seen in the stock markets, that the returns are not normally distributed, rather they are leptokurtic. And in case of leptokurtic, standard deviation is not the sole measure of the risk. We need to take the kurtosis and the tail risk into account. Okay, let's talk about further. When I am talking about the risk for the portfolio, I cannot simply add the standard deviation, because when I say risk of a series, because this is a second moment, it depends upon the average. Okay, so here average is different. For this series, average is different. The average of a blue series is different from average of the red series. Okay, and their variance or standard deviation we are calculating from the averages. So that is why we need to calculate the covariance also. That means how they are co-varying with each other. So having said, how do we do it? If it is a 2-asset portfolio, you know how to calculate the weight, you know how to calculate the standard deviation. So we will say W1 square sigma 1 square W2 square, sigma 2 square, and in these, when we are taking the cross section of asset 1 and asset 2 in these two cells, we are taking cross section of asset 1 and asset 2. We will take W1, W2 covariance between first and second. Okay, here. Done? So since this is for the variance, we will take the under root of this, and here it comes out to be standard deviation, where covariance is equal to, from your statistics class, you know, this is standard deviation of 1, standard deviation of 2, and correlationship between 1 and 2. We prefer to take correlationship because, you know, its value varies from +1 to -1. It is independent of the units, and that is why there are certain advantages which we have for the correlation. So we do not talk about the covariance, rather we always talk about the correlationship. Now, coming from that, when we are combining the assets, okay, do their correlation carry some kind of information? Yes, we will do it in detail that in class, but for your purpose, when I am combining the two assets with negative correlation, clear, we get the benefit of the diversification. And what do I mean by diversification? Diversification is that the combined risk is less than the individual sum of risks. Suppose, so this is, you know, a very interesting property, and that is why we wish to combine the assets of two different type of assets when they are negatively correlated. How does this come? So when I say W1 square sigma 1 square plus W2 square sigma 2 square and plus 2 W1 W2 sigma 1 sigma 2 and correlationship between 1 and 2. If I say, let's take three values. If I say 0, correlation is 0. Okay. If it is 0, I have only these two values. So that means my risk is only the sum of these two values. No additional risk. If I say they are positive, so some more additional risk is being added. See, this term is added. If I say this is negative, so that means out of these two, sum of, see, I said sum of these two, and we are going to subtract these term out of this. So my overall risk come down. So this is known as the diversification. Okay. Because of the diversification, we can minimize the risk and can maximize the return. So, what do we learn from all this? The moment I increase the number of assets from 2, I get multiple. Say, मेरे पास 4 assets हैं. See, these are the terms where we are having W1 square, W2 square, okay? Asset 1, asset 1, 2, 3, 4, asset 1, 2, 3, 4. Done? Here, and here, see, what you are going to get? Asset 1 with 2, asset 2 with 1, asset 3 with 1, asset 4 with 1, asset 2 with 3, asset this. So this is a mirror image of this. Okay, but how many covariances I got? 1, 2, 3, 4, 5, 6. So I got 6 variances when I have got 4 asset covariances. So that means when I am managing n assets, I need to manage n variances and n square minus n divided by 2 covariances, which is too much. Suppose I have got 25 assets. See how many variances and covariances I need to manage. This is fact number 1. Fact number 2. There is limit to diversification. If we keep on adding even the negatively correlated assets, we are adding something to that. Okay. So that is why when every, what you are going to reduce? The covariance term, but you have already added some variance. So the net effect should be lesser. So the more number of assets we keep on adding, there will be lesser the effect of the each addition. So that means there is a limit to diversification. Risk cannot be made zero. Number 3, there is some risk which will remain undiversified. This undiversified is known as the market risk. Okay, and there is some risk which we always can diversify, which we'll call as specific risk. Okay, done. We call this specific risk as unsystematic risk, and we call this risk which cannot be diversified as systematic risk. Okay, now let's learn more about the second measure for the risk, which is not an absolute measure, which is relative measure. That means now we are going to measure the risk with respect to a single portfolio. Okay, this is an asset and this is a well diversified portfolio. And this well diversified portfolio, I will call this well diversified portfolio as a market portfolio. Okay, so that means no more benefit of diversification can happen to this. That is one thing for sure. So how much this risk is going to vary, the asset risk is going to vary with this portfolio is known as, please understand, this is known as beta. Clear? Beta is covariance between the security and the market divided by the variance of the market. We can write it like this also. Correlation between security and the market, standard deviation of the security, standard deviation of the market divided by variance of the market. What is the advantage of going to the beta? Number 1, it reduces the number of covariances. We need not to manage the covariances. We will simply manage beta. Number 2, betas are additive. Just like I calculated the risk for, return for the portfolio, which was WIRI, I can calculate the risk for the portfolio is going to be weighted average of the betas. Isn't it easy? I just need to look at the beta and nothing more than that. Now, if you have a risk, given risk, what is going to be the return? Because that is my objective. If I am taking 5% risk, how much return I should expect? I should expect, okay? So we have got two models related to this which define the relationship between risk and the return. First one is the market model. So what does market model says? Market model is very simple. It doesn't assume any risk-free asset. Okay, so market model says that Ri is equal to alpha plus beta into Rm. We always look for this positive alpha. So that means this is pure return which I am getting without any risk. Capital asset pricing model. We will do this model, these two models in detail later in valuation, but we want to do this. So it assumes that there is some risk-free asset. So Ri is equal to Rf plus beta and Rm minus Rf. Okay, done. So we can calculate if this is the beta. That is an advantage, one more advantage of taking beta. Beta times market return, we are going to get the security return. Beta times the risk premium which market is paying, we are going to get for the security. Can I write it like this? Ri minus Rf is equal to beta Rm minus Rf. Can I write it like this? So we are going to get this much. Okay, this is the same thing which we have got, and we will see how to do it practically in the class. This is a market model and Let's end this. We will follow chapter 7 and chapter 8 for the practice question of Burle Myers. Thank you so much.